Nargis says we are only focusing on Excel today, or we will firstly in first part Excel questions. We will be solving Excel questions, and after break we will do study questions. And in this part you can go in study questions part. You can leave or stay. It doesn't matter. So I think it's recording. Rafael, could you please turn off your video? Great. Then, so we have face value of $1,000. Let's make it dollar. Coupon rate 12.5%. So if coupon rate 12.5%, it means our coupon payments is equal to 1,000 multiplied by coupon rate, $125. So we are done givens, and it asks for how would market price of bond change if market rate is 5%, 10%, 15%. Checked for 3 years and 10 years maturity. Let me write down here rates 5%, 10%, and 15%. Okay. Then interest rate. Let me merge it. Present value. And we have also years here. With 3 years, we have to check it with 3 years and 10 years. So, in order to find present value, we come to the cell and click on function wizard. Find present value here. We have rate 5%, number of periods 3 years, coupon payment this one, and face value that amount. Okay, it gave us with AZN that we converted to $sign. Present value is cash outflow, so Excel gives us with minus sign. Let me delete minus sign here. Okay, great, in order not to make confusing. So we found this way. Also, we can drag the formula for other cells. So therefore, I have to fix some cells here. For example, rate. Let me fix this column. For years, this column. And they are absolute reference. We drag. Okay, we find the present values, and the question is asking provide illustration. We come in short part. We have here lines. I am selecting this one, and let's select data. Let me enter 2 series here. One series named 3 years, other is 10 years. Okay, and 3 years dependent values. Here, X values, interest rates. Also for 10 years, Y values, these ones, and the same for X values, and enter this one. Look at this beauty here. So you see, the one orange line is for 10-year maturity. Green line, blue line is for 3 years maturity. I'm explaining here to you to show that if maturity years, number of years is getting higher, the present value the present value of the bond, if it is premium bond, because we have here 5%, 10%, they are premium bonds because they are premium bonds because they are less than 12.5%. But this one is discounting bond because this rate, interest rate, is higher than 12.5%, which is coupon rate. So in premium bonds and with a longer maturity, they take very sharp start, very higher start. So 10 years maturity started higher than other one, blue one, with 3 years maturity, but ended less than 3 years, because look at the 15% present values, it is less than for 10 years maturity than 3 years. And this chart explains better in this case. Present values upon maturity. Okay. So it is question 1. That's what question 1 is asking from us. Any questions? Gachai asks, can you please explain the concept of present value? I mean the logic in the situation. Present value is the price of the bond. Gachai, present value is the price of this bond. We are finding here present value because it has the face value is given, face value is nominal value, which is written on the piece of paper. For example, 1,000, for example, 100. It has coupon rate and also coupon payments, and it can have different maturities for 3 years, 10 years, or 15 years, and also different interest rates. So we are comparing here the present values, how present values change, the interest rates, and maturities, years change. If years goes up, the present value is getting decreased. Also, depending on interest rate, for example, in higher interest rate, they decrease at higher amount than less one. For example, you see the orange line, the present value of 10 years bond started very sharp increase, higher than 3 years, but ended lower than 3 years. That's what I'm explaining here. Present value is the price you are paying for purchasing bond. Is it clear, Gachai? Yes, Safar Agha. Present value is the amount that you are paying for bond. Okay, if there is no question, we can continue with the second one. The second question says market price of the bond is $1,038.75. If discount rate in Azerbaijan is 6.25%, what will be the coupon rate? Assume face value is 1,000 as always, and time to maturity is 4 years, and coupons are paid quarterly. Let's write here question 2. We have price of the bond, $1,038.75. We have interest rate, (6.25%), but this is annual interest rate, annual discount rate. The bonds paying quarterly, so we have to divide it by 4. It should be also discount rate. Discount rate, okay, equal 6.25% divided by 4, because 6.25% is per annum, per annual. Our bond paying quarterly, so we are dividing by 4. It gives us 1.56 per each quarter. We have face value, which is 1,000. And we have periods. Our periods is 4 years, but our bonds are paid quarterly, so therefore we have to multiply 4 by number of quarters in a year. 4 by 4. 16 quarters. So in order to find coupon rate annual, because the question is asking for coupon rate, we should be converted to annual. We are coming to here. Let me find PMT here. So PMT is equal to rate, discount rate, this one, number of periods 16, present value minus this one, and future value. So our payment is 18.38. Let me convert to the dollars. Okay. In order to find coupon rate, you know coupon rate is you multiply it by face value and you found payments, coupon payments. So we are doing in this case vice versa. Divide PMT by face value and multiply by 4. Why 4? Because the payment we found here is quarter payments. So we should simply multiply by 4 in order to find annual coupon rate. So this is our annual coupon rate. Any questions? All clear, great. Yes, I can show Fatima. Look at here. The coupon rate is the rate you multiply by face value and find present coupon payments, right? Like we did here. We are given face value, we are given coupon rate, and we find payment by multiplying each of them. So in this case, we don't have coupon rate, instead we have payments. So we are doing vice versa. We divide payment by face value. Let's make it together. PMT divided by face value. And this once we are finding here is quarterly coupon payment. But the question is asking annual coupon rate. So therefore multiply by 4 in order to find annual 7.35% annual coupon rate. Is it clear now? Gachay and Asadullah, is it clear for you also? Nermin says, what's price? Is it present value? Yes. Price is present value. You are paying this amount to purchase a bond. The nominal value, face value, is not the price you are paying. It is future value. Okay, then if there is no any questions, we can continue with question 3. We have interesting question here. Question 3. We have table here with maturities 1 year, 2 years, 3, 4, and 5, and yields. Musa is planning to purchase 2-year bonds, 2-year bond in 3 years from now, which means Musa will purchase a bond after 3 years, and bond has 2-year maturity. Assume face value of the bond will be $2,500 and paid 4% coupon rate annually. Find the present value of the bond at now. At now means discounting present value of the bond or price of the bond to year 0, because we will find the price of the bond in year 2, because bond is purchased in year 2. But we want to find the present value of this bond now at year 0. So let's start with maturities. We have maturity 1 year, 2, 3, 2, 3, 4, and 5. We have yield 6%, 6.2%, 6. Which was it? 4%, 6.5%, and 6.7%. Okay. We have yields and we have maturities. The bond, our bond, will be purchased in 3 years. Not here, not here, not here. It will be purchased in 3 years, at the end of 3 years, and it will have 2-year maturity. So our bond will be something here. After 3 years, it will be traded between year 4 and 5. And the question, we will first find what will be yield of this bond after 3 years, 2 years, with 2 years maturity. We have generally let me merge them. For 5 years, we have 6.7 maturity, right? And for 3 years, we have 6.4%. And we have to find this one, this rate. Let me color them. Okay. 5-year yield is 6.7, 3-year yield 6.4, and we are supposed to find this one after 3 years, 2 years. After 3 years, bond with 2 years maturity, the yield of that bond. We have a great formula for it. We type just equal one plus, or is it one plus this one to the power of 5, or just write 5 divided by 1 plus this one to the power of 3. Okay. This number is not get from square root, so we should take square root of it because it is made to the power of 2. Let me write a square to here and minus 1. So our yield, the bonds yield, is 7.15%, which we will be yielding 3 years from now. So let me write the givens. The face value is that amount, 2,500. Coupon rate is 4%, which means our coupon payments is equal this one, face value multiplied by coupon rate. We have interest rate, which is what we found here, 7.15%. We have years, 2 years, because the bond has a maturity of 2 years. So let's find PV. We come here, present value, rate, that one, number of periods, 2 years, payment $100, future value, this one. Let me put minus sign here. Menfi olmasın. Okay. So we found present value of the bond or the price of the bond, but it is after 3 years, at years 3. So therefore, in order to find the present value of the bond now, we should discount we should discount 2 years back. So I mean 3 years back. PV at 0. We are here. Now it is 1, it is 2, 3, 4, 5. The bond is purchased here. We should discount 3 periods back. Equal present value of the bond divided by 1 plus this amount to the power of 3. And it is our result. Any questions? It is hard, I know, but I will send the questions, Kasay. So what we did here, we first found the bonds yield, bonds rate, which is traded in 3 years with 2 years maturity. Then we calculated present value, but this present value is here at the end of year 3. So in order to find present value at now, we should discount 3 years back at year 0. Therefore, we divided the present value or price of the bond 3 years back. And 3 years yield or interest rate is 6.4%, and to the power of 3. Fatima, can you please explain again? You discount previous input. Okay, guys. Fatima says, how did you find 7.15? Fatima, it is formula. Yield'ın formulasıdır da siz bilmirəm chapter neçəydi, 7 idi ya 6-nın axırı idisə o formulanı yieldləri öyrənməliydiniz. Necə tapılır? Məsələn, bunlar məsələn 1 illik, 2 illik, 3 illik, 4 illik, 5 illik yieldlərdir. Və bizim bondumuz da 3 il bundan sonraki yielddə. Yəni burada yox, burada yox, burada. 3 il bundan sonraki yielddə trade olunacaq. After 3 years. Ona görə bunun yieldini biz tapırıq. Bunun da yieldini tapmaq üçün 5 illiyin option'ın yieldini, bunu da rəhləmişəm də 5 il üçün. Option'ın yieldini 5-ə yüksəldirik, bölürük 3 illiyin yieldinə ki, 2 illiyi tapaq. Elə bir ki, 5 illiyi bölsən 3 illiyə ki, 2 illiyi tapasan. 5 illik bu qədərdir, yüksəltdik 5-ə, 4 illik bu qədərdir, yüksəltdik 3-ə, onu 6.4, tapdıq 7.15-i. Burada SQRT falan eləmişəm, çünki bu 7.15 belə deyim də, üstü kvadratdır. İndi məsələn, belə eləyim gəlin sizə. Bu neçə illikdir? 3 illikdir. 1 plus this rate to the power of 3 multiplied by 1 plus this rate to the power of 2. That's 2 years. We find 2 point something, anything. This is bu 2.58 deməli faizin 5-ə yüksəlişidir. Çünki biz rate yazırıq axı 1 üstəgəl bu üstü 5-dir də, to the power of 5-dir. Ona görə biz bunu 5-ci dərəcədən kök alttasını tapırıq. Üstü 1/5. Bu ne düzgün alınmadı. Bir dəqiqə belə edeyim. Burada şey olub. That's my bad. Okay. İndi düzdür. Və sonra da buradan 1'i çıxırıq. Çünki 1 plusdur da. Tapdıq faizimizi. 5 illiyə eynidir. Yəni ikisini də vurub tapa bilirsən, eyniliyi yoxlamaq üçün ki, dəqiqdir. Və yaxud da belə 5 illiyi bölürsən 3 illiyi, 2 illiyini tapırsan. I hope it's clear. It is given in the question, Faruk. 1 year 6%, 2 years 6.2%, 3 years 6.4%. But this year starting from year 0. Yəni 2 illik burada vermişəm, 1 illik, 2 illik, 3 illik. Bunların hamısı year 0'dan başlayır. Məsələn, 1 illik bond 6%-lə trade olunacaq. 2 illik bond buradan başlayır. 3 illik bond buradan başlayır. 4 illik bond buradan, 5 illik də yenə 0.0'dan başlayır. Sən buradan başlayıb deyənmərsən, bu 3 illik bondda 6.4'da trade olunacaq. Xeyr. Çünki sən year 0'dan başlamırsan. Bu pure expectation theory. Pure expectation theory nədir? The estimated value of or estimated yield of current long-term yields for short-term current yields. Yəni long-term indi verilib 6%'dir, 6.2, 1 illik, 2 illik, 3 illik, 4 illik, 5 illik verilib indidən. Bunlar long-term rate'lərdir. İndini, current'a görə. Amma gələcəkdə bilməyəsən axı 2 illik nə qədər olacaq, 3 illik nə qədər olacaq. Məsələn, burada 2 illik nə qədər olacaq? Onu tapdıq ki, 7.15% olacaq. Yəni, pure expectation theory bunu izah edir. Okay, I can write formula text. Bir dəqiqə. Is it clear? Najis says, can you show print the formula on the screen, please, of finding yield? I keep getting 7%. Nermin, formula is here. Formula is in your PPT or formula. Çağatay müəllim set the formula how to find. Yeah, let me write on the paper. I will do this way. One plus .7%. To the power of 3 to the power of 2 . Baxın uşaqlar, video, in order to make it widescreen, please click on my video to see my video in widescreen. Simply belə elədik də, birin üstünə 6.4% cəririk. Yəni bunu siz 6.4% kimi yox, number kimi yazasınız. 0.064. Kuba yüksəldirik, çünki 3 illikdir. Vururuq 1 üstəgəl i-yə. I-ni biz bilmirik, elə bizim tapdığımız i-dir. Çünki 2 illik bizə lazımdır. Və tapırıq option 5 illiyi. 1 üstəgəl 5 illiyi rate bizə verilib 6.7%. Let me put percentage sign here. To the power of 5. Guys, I cannot lose more time on solving a question, so my camera on. Farrukh, did you see my video, guys? Ilgar says, is it pure expectation theory? Yes. The fourth question, a municipal bond pays you semi-annual 3% coupon rate, semi-annual 3% coupon rate. And already semi-annual. With face value of 100. It's currently traded in the market at that amount. If it is 1 year bond, find interest rate. We come here, question 4. We have face value of $100. We have semi-annual coupon rate. %3. We have payments, also coupon payments, which means face value multiplied by semi-annual coupon rate. We have market price as well, or present value, $101.84. In the calculation, I will give it as minus because it should be cash outflow and it should be cash inflow. And periods, what's our period? 2-year bond. If it is semi-annually, it means we have 1 multiplied by semi-annual, number of semi-annuals, 2. We have 2 periods, 2 semi-annuals. We have rate. We find the rate. What was the question? Interest rate, yes. But this interest rate should be annual. Come to here, rate, number of periods, 2, payments, 3, present value. Let me put minus here, minus price, future value, face value. 2.5%, 2.05%, but it is semi-annual interest rate. So therefore, multiply by 2. So 4.10%. This is on our annual interest rate. The question is asking that. Any questions, guys? Okay, I am writing here. Any questions, guys? How did you know that initially we found semi-annual interest rate? Because we adjusted our inputs to semi-annual. We have semi-annual 3% rate. It is already given here with semi-annual. It's not annual. We have face value. We have price. We don't change it whenever it is. Doesn't matter. It is semi-annual or monthly or quarterly. They stays the same, but interest rate, coupon rate, and periods change. And it is 1 year bond, so paid semi-annually, which means we have 2 periods. And we find here, of course, annual interest rate 2.05%. It is semi-annual. But the question is asking for annual. In order to find annual, multiply by 2, it will give you annual. Can you show the question again, please? This is the question, a municipal bond. Okay. Who was that? Fatima. Let's go to question 5. Minister of Finance, Maliye Nazırlığı of Azerbaijan Republic issued a bond with nominal value of 1,000 AZN. The bond pays you 0.25 interest monthly. The traded price is expected to be 911 point something else AZN. Calculate how long it will take for this bond to mature. Or it's asking for number of periods, to find number of periods. Note that discount rate in Azerbaijan is currently 6.25%. So let's write what's given here. Face value 1,000 AZN. Okay. Monthly coupon. Monthly coupon rate. Monthly coupon rate is 0.25%, 25%, which means monthly PMTs or just PMTs equal to face value multiplied by coupon rate. Okay. Okay. So we have present value or price, which is 911.03050 AZN. Okay. Discount rate in Azerbaijan, or interest rate, is 0.75%. I'm sorry, 25%, but it is annual discount rate. So we should divide it to 12 because we are required to pay monthly. Monthly discount rate is 0.52%. And periods, we have to find, in this case, yearly periods, equal to, and per rate, PMT, present value, let me put minus sign here, future value. But this 36 is months, number of months, because we are paying our coupon bonds monthly. So therefore, we should divide it by 12 in order to find number of years. We have 3 years, so our bond has 3 years maturity. Any questions, guys? $2.05 neydi sizce? Burada semi-annual yoktu. Yes, I can repeat. Who is that? Asadullah. Look, we have in the question discount rate is currently 6.25%, which is annual discount rate. Because annual discount rate in our language uçot faiz dərəcəsi. Mərkəzi Bankın uçot faiz dərəcəsi saytından da baxa bilərsiniz. Alt tam %25 faizdir. Bu uçot dərəcəsi illikdir, annualdır. It is per annum. So therefore, we have to divide 6.25% by 12, number of months in a year.
Can you hear me?
Yes, I hear.
Yeah, I'm sorry, I don't understand Azerbaijani. I'm foreigner.
Asadullah, you are foreigner?
Yeah, I'm from Uzbekistan.
Uzbekistan. Greetings from here to Uzbekistan.
Thank you.
So Asadullah, the discount rate in Azerbaijan is 6.25%. When you go to the website of Central Bank of Azerbaijan, you will see there 6.25%. This percent is for annual. All these percentages are shown in annual terms. But the question or our bond pays us interest monthly. It is monthly coupon bond. So therefore, we should divide 6.25% by number of months in order to find the coupon rate, discount rate for 1 month. And it is 0.52%. Is it clear? And so as a result, we find periods, 36 periods, but it is 36 months because we worked with months. So therefore, we should divide this month's number of months by 12 because there are 12 months in a year. So we have 3 years. It will take 3 years for this bond to mature. Is it clear, Asadullah? Asadullah, maybe you have, you should increase decimals. Add decimals, yes, as Farooq said. Any questions, guys? Is it clear? Okay, it seems no questions. 6th one. Very easy question. This is very easy. It gave us coupon rate 8% or $80, interest rates 7.6%, number of years 5, present value that amount. Using the information above, find the face value of the bond. So we have coupon rate 8%. We have coupon payments of $80. So we have then interest rate. It is 7.6%. Number of periods. How much is it? 5 years. Present value or PV or price. 1016 point. How much is it? Okay, 1406. This is also with dollar sign. And we are required to find the face value. Face value is future value, so therefore we are using future value formula. We have rate, interest rate, we have number of periods, we have payments, we have present value, but we include present value as minus. So we have got the face value. Face value is 1000. Actually, it is 999 something else, but if we round up, it will give us $1,000. Is it clear? Which formula did we use again? Present future value formula, because we are finding future value. Face value of the bond is also future value. We found future value. Let me do it again. We come here, future value, rate, number of periods, payments, 80, present value with minus sign. Present value, that's it. Any questions? It is just for simplicity. I know coupon rate doesn't work for anything, but I just gave it. Ilgar. In order to understand that if interest rate, coupon rate is 8%, face value is 1000, you have PMT is 80, or you can simply divide this PMT by coupon rate. Belə də tapa bilərsən. Prosto mən sizə formuladan istifadə etməyi göstərdim ki, formulanı biləsiniz. I just saw the formula of future value. You can divide also like that, as I tapa bilərsiniz. You can find in this way. Clear? And we have interesting question here. Which question? 7th question. Have you heard about leasing? Televizyonda deyirlər. In the TV, you frequently hearing leasing conditions. You can you can purchase a car with leasing. So we have here a simple leasing question. You see an advertisement on TV offering you purchasing a car by leasing it. Leasing payments are $388.94 per month, dollars per month. The lease due is 54 months. You are required to make an early down payment of $2,160. Advertisement also indicates that residual value of the car is $22,460. After calculation, you concluded that total price is $30,500. What quoted interest rate will your car be leased with? Guys, it is simply the same with bond calculation. Leasing payments are coupon payments. Lease due is number of periods. Residual value is future value. And total price, also you are making early down payment. Your present value will be total price minus early down payment, because you are making early payment and the rest payment will be paid by leasing payments. So let me write here total price $30,500. You have early payment, early pay, $2,160. It should be like that. Okay, yes. And so we subtract it. We are finding present value, total price minus early payment. Our present value is $26,340. So we have also future value, PV, which is residual value of the car, $22,460. And we have leasing payments, which will be paid monthly, $388.94. Okay, and we have months, 54 months. So everything is given. You can find rate, annual rate. Because the question is asking what quoted interest. Quoted is annual rate. Come here, type on rate, number of periods. Actually, it shouldn't be in dollar terms. By default, Excel gave us is an accounting format. Okay. Come here, type rate, annual, number of periods, months, 54, payments. This one, present value, minus, let's put minus sign here, future value, that amount. Okay. We found the rate, but monthly rate, because our payments are made monthly. So in order to find rate annual, just multiply by 12, because there are 12 months in a year. You will find 13.06%. This is quoted interest of leasing. Any questions? Axırıncı sual qaldı. We have left with 8 question, but this is explanation of net present value. Dözün break time'dan sonra davam edəcəyik. Net present value ne? What is net present value? In Excel, there is a function of net present value. Let me write here question 6, 8. Net present value formula or function in Excel actually finds present value, not net present value. I will show why. Let me give you some annuity payment. Discount rate 10%. We have years. Years 0, 1, and we have, for example, let's say 10 years. We have 10 years, and all the payments are made at the end of the year. Equal payments, series of cash, $50,000. So this is present value of annuities. Let me write present value here, and also present value here. In order to find the present value of this, say, investment, which pays you a series of cash flows over 10 years, this one divided by 1 plus 10%. Let me fix it. to the power of 1. And summation of it will give us the present value. Okay. This is the present value of investment, present value of annuity cash flows. In the formula, net present value formula, you can also find NPV. It wants you to enter rate, discount rate, and cash flows. Enter. You see the same result. Nothing is different. But this net present value, Excel's net present value, it is not actually net present value, it is present value. Net present value of Excel finds the present value of future cash flows, but in reality, net present value is equal to present value of cash flows minus initial cost or initial investment. You don't cover it in Principles of Finance course, but we are using net present value formula here, therefore it is necessary to know it. Net present value is used to evaluate the projects. For example, let's take a company, Apple. Apple has to implement a project. This project requires, for example, $250,000 investment. So you have to invest $250,000 investment in order to implement this project, and this project will bring you these cash flows. So net present value is equal present value of future cash flows minus initial cost, initial investment. This is net present value. So if net present value is positive, it means higher, greater than 0. It means the project is accepted. And Apple will implement this project. Otherwise, for example, net present value can be negative. Let me increase the initial cost, 350,000. You see, the net present value is negative. Negative net present value because the initial cost is higher than present value of future cash flow. So this project should be rejected. This is real net present value. The net present value is the concept of net present value is that is what we calculated here. But Excel, what Excel's NPV calculates, or we can simply calculate NPV rate equal cash flows and minus initial cost. The same result. Excel's NPV is just finding present value, not net present value. I don't know why they did like that, but it is reality. So I hope it is also clear. Any questions about it? How did you determine? I just determined. For example, there are project cannot be implemented without investment. You have to invest in project. You have to pay for project to implement it, and project will bring you this series of cash flows. I just gave a number. I can increase it or decrease it. Increase edirəm, artır net present value. Daha doğrusu azalır. Çünkü why? Because present value of these cash flows is less than initial investment. So net present value of this project is negative. Project shouldn't be implemented. It should be rejected. But if I do 250,000, net present value is positive. So it means it doesn't mean İlqar. İlqar bunu dedim ki, yəni Excel'də NPV formulası var və biz bunu hal-hazırda işlədirik present value tapmaq üçün. Və bunu özümə bir növ belə deyim, borc hiss elədim ki, bu net present value-nun əslində nə olduğunu sizə izah edeyim. Yəni əslində Excel'in net present value-su present value hesablayır. Net present value hesablamır. Gördünüz, net present value hesaplamaq üçün we use the formula net present value and minus initial cost. Bunu mən sizə göstərmək istəyirdim ki, net present value görəndə çaşmayasınız. But you don't cover the concept of net present value here in Principles of Finance course, and you will not be tested on net present value. It's just explanation, additional info. So guys, we have done with Excel session. What's the time here? Let's take a break and be here at 9. What's the time? 19:20. 19:20'de burada olun. Study question'lara başlayacağıq. I will not be able to attend the second. Okay, it's əvvəlcədən dediyim kimi, you can either participate or leave. So 19:20'de burada olun. Be here at 19:20. Don't leave the session. Let me. Okay. Okay, I think we can start. It's time here. And I hope some of you hearing me. Do you see the screen? How many participants are left? 18. Not bad. İkinciyə çox vaxt qalmırlar. Hələ Excel-on öyle ikinciyə elədim ki, daha doğrusu ilk başda elədim ki, static question'ların bəzilərini onsuz da işləmirsiniz. Bəziləri işləmirsiniz. Ona görə sürətli gedəcəyik ki, buna da vaxt etməsin. I know you are tired, I am also tired, but it is the procedure. And I hope you are learning something in each session. So, let me start. First, study questions 2. First question says, suppose your bank offer your time deposit with 2-year maturity, quoted 8% interest rate and paid interest quarterly. You decide to invest 10,000 AZN. What will be the worst at maturity? This is simple, very simple calculation. So you have number of periods is equal to 2 year, but it is paid quarterly, so therefore multiplied by 4, you have 8 periods. Interest rate R is equal to 8%. It is annual, so we divide it to 4, it is 2%. We have present value, we are investing 10,000 AZN. So what will be the future value? The question is asking for future value, 10,000 multiplied by 1.002 to the power of 6. And it should be something, let me calculate it, 102 to the power of 8. 11,716 point. Do you see what I wrote here? Please click on my video below to see it widescreen. So I just divided number of periods multiplied number of periods 2 years by 4 because it is quarterly 8 periods, as well as interest rate divided by 4 because it is annual interest rate, so we divided by 4 to find the interest rate for quarter, 2%. We have present value 10,000 AZN, so this is the formula of future value compounding, and the answer is that. Is it correct with your answer? Sadat, please click on my video below to see it widescreen. Widescreen. Guys, həmişə please use 4 digits after comma. Çağatay müəllim will be asking for it also in quizzes and midterms. Use 4 digits after comma. Okay. Second question, a bank offers you 6% nominal interest rates and compounded monthly. You decide to invest 100 AZN for 1 year, what's the future value of investment? Rate is 6%, but this is annual rate, so we divide it by 12. It should be 0.5, I think. Let me divide it. Yes, 0.5%. Number of periods, Empire, is 1 year, but it's paid compounded monthly, so therefore we multiply 1 year by 12. It gives us 12 months. Investment, present value, 1000 AZN. So the same thing. In order to find future value, we multiply present value by 1 plus 0.005 to the power of 12. Let me calculate it. Oops. Do you see it? We found rate, 6% was quoted annual rate, we divided by 12, and we found 0.5 per month. Also for number of periods, we have 1 year, but it's compounded monthly, so we multiply 1 year by 12 months. Present value is, which means the investment amount, 1000 manats. So future value is 1061 point something else. I hope it is the same with your answer. Great then. Third question, you want to buy a new mobile phone. Phone seller offer you a loan for a part of the purchase price a new mobile phone. His quotation rate is 8.5% nominal annual rate. What is effective annual rate? Effective annual rate, guys, this has formula. You just plug in the number annual rate into the formula. So we have rate 8.5%, nominal rate, nominal annual rate. To find EAR, 1 plus 0.00, not 0.85 divided by 12. Okay. One plus 0.012 over 12 minus 1. And it should be 1 plus 0.085 over 12 to the power of 12 minus 1. 0.812 to the power of 12 minus 1. 8.84%. I used 2 digits after comma just for simplicity. I use 4 digit. Also the same answer. Great. This is very easy question. No need for explanation. I have a question in previous question. It's also said annual, and we divided rate by 12. Do we do this here as well, or it was because compound monthly? In previous question, it is compounded monthly, So it gave you 6% nominal interest. Nominal means annual, and compounded monthly. So simply you divide 12 by 12 so in order to find a nominal interest for months, and number of periods 1 year, but it is compounded monthly. So you are multiplying 1 with 12 periods. That's it. Fatima the same. It is just rounding error. 8.83, 90, 90, 589 belə gedir. Yəni rounding error. Yuvarlaqlaşdırdım deyə 8.84 alındı. The same. Which solution, Nuriye? You mean this one? Okay. Did you got it? Okay. Fourth question. An Azerbaijani fast mover consumer goods company sales increased from 1,500 million ASEAN in 2015 to 12,155.06 million ASEAN in 2018. They calculate the sales growth rate for this company. Guys, I am sure that some of you, I can say most of you, find just yearly change, percentage change. You just subtracted 1 million from 12 million and divided by 10 million and multiplied by 100%. That's not true answer because it's not gross rate. It is yearly change. The question is not asking for your to find yearly change. The gross rate is simply what you are finding in interest rate. It is simply for also gross rate. So we have present value million and future value million. We have number of periods 3 years because there is 3 years between 2015 and 2018. 3 years. So one plus I to the power of 3 is equal to it should be 5%. Sadat, which question? Answer for previous is 8.84 or 8.83 something else. If you are asking effective annual rate percent. For this one, the interest rate is 4.99% or 5% gross rate. You have present value 10 million, future value 12 million. Yes. And you have number of periods 3 years because present value is in 2015, future value is in 2018. 3 years difference. And you find gross rate by solving the equation for I, not yearly change. This is your answer. Any questions? Clear. Okay. The same thing also works for Ali. Let me admit it. Guys, please join through the channel, not any link, because if you join with link, it will bring you to the lobby and I should admit it. but join this link without any problem. Join this channel. I'm sorry. Okay. Fifth question says same company's net profit declined from that amount in 2015 to this amount. Calculate net profit growth rate. So the profit rate, growth rate declined, therefore growth rate should be negative. Present value and future value 18.81 M. Number of periods 3 years. So net profit growth rate 54 plus I, and growth rate should be -1%, I think. Is it the same answer as you got? -1% growth rate. Minalli, özüm de tezden hesaplayayım. So square root of it -1. Yes, 1%. You did it wrong, but now it's clear. Yes. You're just finding the interest rate, compounding interest. Yes, some of you, I know most of you found percentage change, but it doesn't ask for percentage change, yearly percentage. It is asked for growth rate. It is asking for rate, not change. Okay, if you understand, it's clear. The last question, you want to buy a car and the local bank will lend you $20,000. The loan will be fully amortized over 5 years and nominal interest rate will be 12%, interest rate paid monthly. What will be monthly payment? It is just formula, present value formula. So we have here the amount of money you took from the bank, $20,000. Number of years, 5 years, but it's paid monthly because it is loan, 60 months. And nominal interest rate is 12%, but it is paid monthly. So therefore, divided to 12, 1% per month. What will be monthly loan payment? The payment is equal to bölünsün 1 minus 1 böl 1 tam %1 üstü 60 0 tam %1. And it should give us bölünsün 1 minus 1 böl 1 tam %1 üstü 60 böl 0 tam %1. 444.89. Do you see this beauty? You gave inputs, find PMT by the formula, and it gives us 4,444.89. Okay, I think there is no any question. Also, what will be Nominal interest rate. What will be loan's effective annual rate? Effective annual rate, we just calculated recently. Let's calculate it for 12%. If it is paid monthly, EAR is equal to 1 plus 0.12 over 12 to the power of 12 minus 1. And it should be 12.68%. Let me check it if it's correct or not. Over 12 to the power of 12 minus 1. Yes. This is false also for AR, effective annual rate. Do you have any question? I think no question. There shouldn't be a question. We finished study questions 2. Let's switch to study questions 3. They have some theoretical questions. Bunlara vaxt az gedəcək. Yəni, çox az. Cameron, do you know whether bond valuation will be in the quiz? You might have. You might have. But Çağatay müəllim hasn't decided yet because in the email, I saw the email because mən də CC-yə qoymuşdu orada, gördüm. Orada midterm mövzularını yazmışdı. Amma belə baxanda quizə theoretical sual salmağın mənası yoxdur. Yəni indiyə qədər də salmayıb, heç bizə salmayıb, ancaq məsələ salıb. Ona görə düşünürəm ki, sizə də salacaq məsələ sualları, biri də bonddan ola bilər. Amma Blackboard-da eləyirsə çox güman multiple olacaq sizə. Bizə eləyəndə açıq sual idi, 3 dənə açıq sual idi. Bilmirəm sizə indi necə eləyəcək, Blackboard-da eləyəcək və multiple eləyəcək or open-ended, I don't know. Ola bilər, yəni bonda aid ola bilər. Okay. Let's start with study question 3. The term structure of interest rates is the relationship among interest rates of different bonds with same risk and maturity. That's not correct. Because term structure means maturity structure. And it doesn't make sense if we take same maturity for different bonds. We are not comparing bonds. We are comparing here maturities. So A is not correct. The structure of how interest rates move over time, no. The relationship among the terms to maturity of different bonds from different issuers, there is nothing with issuers. D is correct because the relationship among interest rates on bonds with different maturities but similar risk. The same risk, the same interest rate, but different maturities. Which of the following long-term bonds should have the highest interest rate? Guys, we have 4 bonds here: corporate BAA, treasury bonds, corporate AAA, AAA means AAA, and municipal bonds. Always remember that treasury and municipal are government bonds. Treasury is government, municipal also belediye bondları, they are also government. Because they are less risky, they don't have actually risk or probability to go bankrupt, so therefore they should have the lowest interest rate. Coming to corporate bonds are classified based on their risk of probability of going default. AAA or AAA bonds, or the ones with the A grade, they are investment grade bonds. They have lower default risk, lower interest rate risk, so they are safe to invest. Corporate AAA is more safer or less riskier than corporate BAA because it has BAA, B grade it has, but it doesn't have B grade. All of them are AAA. So therefore, corporate BAA is more risky or has more a little bit more default risk to go bankruptcy. So therefore, corporate BAA bonds should have highest interest rate among corporate AAA bonds, also treasury bonds. For the first one, the answer is D. Third question, bonds with relatively low risk of default are called investment grade bonds. Zero coupon bonds doesn't have anything for zero coupon bonds. Zero coupon bonds means it doesn't have coupon payments, coupon rate. It also pays you at the end of the maturity only face value. Doesn't pay coupons. Junk bonds, they have higher risk of default because they are junk. Investment grade bonds, as I said before, AAA bonds, B bonds, they are considered as investment grade bonds, safer for investment. James Bond, bu Çağatay müəllimin zarafatı olub burada. James Bond bondu yoxdur. Yəni elə bir bond yoxdur. Ona görə cavabımız C, investment grade bonds. If a corporation suffers from big losses, the demand for its bonds will rise because of higher interest rates the firm must pay. The spread between interest rates on bonds with default risk and default-free bonds is called the risk premium. First one is false, second one is true. Why first one is false? Can any one of you explain it? Because only I am talking, I want you also to interact. Open your microphone and say what's in your mind. Why first one is false?
It's false because when a corporation suffers losses, it will try to raise demand by raising the interest rates. It goes from the interest rate to the demand, not vice versa, not like here.
I got your point, but let me make some adjustments to your point. If corporation suffers from big losses, the demand will not increase. Why? Because also the corporation should pay higher interest rate because high risk, high return. It should be higher rate. But any rational investor, any clever investor, səncə invest eləyər həmin bonda? Do you really make sure that this corporation will be able to pay your coupon rates? Bəlkə default elədi, bəlkə bankrot elədi, ödəyə bilmədi. Ona görə əksinə demand kiçiləcək. Çünki onsuz da bu defaultdadır. Higher interest rate versə ümumiyyətlə yəni ödəyə bilməmə ehtimalı var. It has very high probability to go bankrupt. It will not be able to pay your interest rates. So demand for these bonds will decrease. First one is false. Second one is true because the spread is the difference between default risk and risk-free bonds. Default risk-free bonds is risk premium. Is it clear? No, it is not true. Actually, investors demand or require higher returns on risky investments. Because if I'm investing in risk investment, risky security, you should pay me higher amount because I'm investing, I am putting my money to you. But in this case, corporation suffers from big losses. I am a rational investor. I know that I can't trust this corporation. I don't know what will happen tomorrow. Maybe tomorrow the corporation went to the bankruptcy. What will happen to my money? Will corporation be able to pay money? Of course, no. Therefore, demand will decrease. Demand falls when they for risky bonds, junk bonds. If corporation suffers big losses, its bonds most probably junk bonds. I just missed them. Okay, it means everything is clear for you. Let's continue with 5th question. Moody's and Standard & Poor's agencies are that produce information about the probability of default on corporate bonds. There are 3 agencies that produce information about the probability on default of corporate bonds: Moody's, Standard & Poor's, and Fitch Ratings. They assign letter grades for the banks, for the countries, for the central banks, or commercial banks. These agencies, the duty is producing information. For example, they are analyzing financial statements of banks or countries, and they gave you grade. For example, your grade is A or AA plus or AAA. Bondlar da eyni rate malik olur. Yəni sənin defaultun azdır deyənə mən sənə A verirəm. If default risk getting higher, I decrease your rating to C or to D. It is clear, I think. Okay. The relationship among interest rates on bonds with identical default risk but different maturities is called yield curve. It's also the same relationship among interest rates on bonds with different maturities but similar risk. This relationship is called yield curve. Yield curves can be classified as upward, downward, flat, all of them. It depends on inflation amount. If inflation is expected to go up, yield curve will be upward sloping. If inflation is expected to go down in the long term, the yield curve will be downward sloping. But if inflation is expected to stay the same, yield curve will be flat. No change in the curve. Will be the same. Is it clear? You should have discussed, Fatima. Yes, for the 7th one, it is D, all of above. Upward sloping, downward sloping, and flat, all of above. For the 6th one, yes, the answer is C. Question 8. There is no question. Guys, you should have covered it. I believe you have covered it. Yani bunu kesmiş olmalısınız. Anyway, a bond with default risk will always have risk premium, an increase in default risk will raise the risk premium. Positive risk premium. The answer is positive because if default risk is going up, is increasing, the risk premium should have also increased. There is positive relationship between default risk and premium. So increases default risk goes up, risk premium also should go up. Therefore, positive risk premium, positive relationship. Excuse me, what was the answer for the 5th one? C. Produce information about the probability of default on corporate bonds. Onların işi ancaq ratinglər verimi düzənləməkdir. Bir də corporationlar və yaxud da banklar üçün default riskini və yaxud da probabilitysini ölçməkdir. Onun barədə informasiya verirlər ki, məsələn, bu şirkətin bu qədər lossları olub. This corporation faced this amount of losses, this profit. So therefore, the probability of default is that amount. And as a result, I am assigning, for example, B grade to you, B rating. That's what Moody and Standard Poor doing. Maybe it isn't on the PPT, but Çağatay should have said it. Moody's, Fitch Ratings, and Standard & Poor. Can you please explain what was risk premium? I thought risk premium is spread, difference between the risk interest rate with default risk minus risk-free, default-free interest rate. The premium is fark risk premium. Ilgar. Okay. Now, yields on government securities as follows. Meselelere geldik. If pure expectation theory is correct, what does market believe that 2-year security will be yielding 4 years from now, and 1-year securities will be yielding 1 year from now? We should simply, in this question, we should find the yields of the bonds or securities will be yielding 4 years from now and will be yielding 1 year from now. Let's calculate. So we have 2-year securities 4 years from now. We have overall 6 years. 1, 2, 3, 4, 5, and 6. 0, 1, 2, 3, 4, 5, and 6. Our bond will be traded here. Look, guys, I am talking about A. 2-year securities will be yielding after 4 years from now. In 4 years from now. 4 yıl bundan sonra 2 yıllık security. We have to find this interest rate. In order to find this interest rate, we should divide the interest rate for all the periods, the yield for 6 years divided by yield for 4 years. What is yield for 4 years? 7%. Great. What is for 6 years? 7.5%. You see? Bu hissəni tapmaq üçün 4 il the security will be yielding in 4 years from now. 1, 2, 3. Oops. 1, 2, 3, and 4. 4 years from now, 2-year securities, we have to find this interest rate. To find it, we have to divide this amount, which is 7.5% for 6 years yield, divided by for 4 years yield. All of them, this one and this one, starts from year 0. So simply, we are writing uh, 1 plus 0.08 to the power of 4, 1 plus I to the power of 2, 1 plus 0.075 to the power of 6. You see? Elə bir ki, buradan nə elədim? Belə göstərim. Bu hissəni vururam bu hissəyə. Yəni, I multiply this part to this part and get this part, whole part. So as you see, to the power of 4, to the power of 2, we have to find I. We have to solve this equation to I. And for 6 years. And if we find it, I should be, let me calculate it. To the power of 6 divided by the power of 4 1 plus 0 power of 6 divided by the power of 4. Okay. Square root of it minus 1. 8.5%. Guys, I am very sorry. Ben bir nəfərə bir şey göndərməliyəm. Okay. So we found I, 8.5%. Is it the same answer with you? With yours? Great. For the next one, 1 year securities will be yielding 1 year from now. This is very easy. Three. 1 year securities will be yielding 1 year from now. %. Which is 5.5%. The second question, 1 year securities will be yielding 1 year from now. It means this part. We have to find the yield of this security traded here, I. We should simply divide the yield for 2 years by 1 year. We will find this one. So, 1 plus 0.05, 1 plus I, 1 equal to 1 plus 0.055. I is equal to the power of 2 over 6.0024%. You see, 1 year, 1 year, 3 years. Let me show it this together. I took 1 year yield multiplied by this 1 year yield, which is our yield of security, is equal to 2 years yield, 5.5%. This one 5%, and this I is 6.0024%. Is it the answer? as you got? Okay, great. Real risk-free rate. You read in the Wall Street Journal that 30-year T-bills are currently yielding 5.5%. Your brother-in-law, a broker at Safe and Sound Securities, has given you the following estimates of current interest rate premiums: inflation, liquidity, maturity, and default. On the basis of this data, what's the real risk-free rate of return? Guys, rate of return should be consist of risk-free rate and plus risk premiums. We have 4 risk premiums: inflation risk premium, maturity risk premium, default risk premium, and liquidity risk premium. But all these risk premiums will not be together in all the securities. It depends on the type of security and the maturity of the security. The type of security can be 2 types: government bonds, government securities, or corporate securities. And they both have 2 maturities: long-term, short-term, long-term, short-term. Is it clear? So our security is T-bills, which means treasury, government bonds, government security, and also 30-day, which is short-term. So short-term government security or treasury security, treasury bills should have risk-free rate and plus only inflation. No liquidity, because the government bond securities are the most liquid ones. No maturity risk premium, because it is 30 days, small maturity. It is short-term maturity, because it doesn't have a long-term maturity. So no maturity risk premium and no default risk premium. Government bonds cannot go into bankruptcy or cannot default, doesn't default, because government has print machine. So whenever they are suffering from lack of cash, they will print your money and give it to you. No default risk. Therefore, we have only inflation risk premium and risk-free rate, and our yield is 5.5%. Let me write here. R is equal to 5.5%. We have only the inflation risk premium, IPE, 3.25%. So our risk-free rate, RF, is equal to 5.5 minus 3.25%, equal to 2.25%. You see? Is it clear? Did you got the same answer? Did you get the same answer? Clear. Let's go to the 11th question. Expected interest rate. The real risk-free rate is 3%. Inflation is expected to be 2% and 2% this year, 4% during the next 2 years. Assume that maturity risk premium is 0. What is yield on 2-year treasury securities? And what is yield on 3-year treasury securities? So we talked about treasury securities. They are government securities, and also if they don't have maturity risk premium, it means they are short term. Also 2 years and 3 years, they are not considered actually long term. They are short term ones. So short term treasury securities or government securities, as we said, should have risk-free rate and also inflation, only inflation. No liquidity, no maturity, and no default. So let me write here 2 years. R is equal to what's our risk-free rate? 3% plus expected inflation is expected to be 2% this year and 4% during next year. 2% plus 4%, we take average of them and equal to 3%, 3%, 6%. For 3 years, R is equal to, again, 3% because it's risk-free rate, plus 2%, plus 4%, plus 4%. Average, and it should be 2 plus 4 plus 4 on, let's say this one. %6.33%. Is it clear? Can you show again, please, number 10 calculation? The guys all read this. Okay. It is clear, this. To take average, because we have 2 different interest rates, inflation, and 3 different inflation, we take average. Okay. Default risk premium. A treasury bond that matures in 10 years has a yield of 6%. A 10-year corporate bond has a yield of 8%. Assume that liquidity premium on corporate bond is 0.5%. What is default risk premium on corporate bond? So guys, we have 2 long-term bonds. 2 long-term bonds. One of them is government. One of them is corporate. As we said, government long-term should consist of risk-free rate plus 2 risk premiums, inflation and maturity. Why maturity? Because it is long-term. No default, no liquidity. But in long-term corporate, we have all of them. Risk-free rate plus inflation plus maturity plus default and plus liquidity. So therefore, simply, we write for treasury, we have R is equal to, what's our risk-free rate? Risk-free rate is not given also. RF plus inflation premium plus maturity premium, maturity risk premium is equal to 6%, right? And for corporate, R is RF 6% plus liquidity LP plus default is equal to 8%. Look at here. Treasury bonds yield is equal to risk-free rate plus inflation premium plus maturity premium, and is equal to 6%. In the question it is given. For corporate bond, it includes all of them. Risk-free rate plus inflation premium plus maturity plus liquidity plus the default. I replaced this one. I replaced here this one here with 6% because it's already included here. 6%, and we are adding liquidity and default. In the question, liquidity is 0.5%. So let me write it down. 0.5% plus default risk premium. Default risk premium is equal to 2%. And DRP is equal to 1.5%. So in order to find the summation of liquidity and default, I subtracted 6% from 8%, and it gave the sum of them gave 2%. We have 0.5 liquidity premium, so default risk premium is 1.5%. Is it clear, guys? Clear. And the last question. Maturity risk premium. The real risk-free rate is 3%. Inflation is expected to be 3% for the next 2 years. A 2-year security yields 6.2%. What is maturity risk premium for 2-year security? So R is equal to risk-free rate 3% plus inflation. Inflation is expected to be 3% for the next 2 years. We have 2 years, 2-year treasury yields. So in order to find inflation, we should take average of 3%. 3% plus 3% divided by 2. Then maturity risk premium. MRP is equal to 6.2%. We don't have liquidity, we don't have default because it is government bond, it is treasury. So our MRP is 3% plus 3% plus MRP is equal to 6.2%. MRP is 0.2%. Look at this beauty here. Nuria, I will show you question 12. Just wait. So it is government bond treasury. It has only risk-free rate, inflation, we took the average, and MRP, because MRP is given, which means it is long-term government, is equal to 6.2%. We solve the equation for MRP and we get 0.2%. If it's clear, then we can switch to Back's question 12. Default risk premium. Nermin, Nuria, listen. The question says a 10-year bond matures, treasury bond matures in 10 years, which is long-term treasury, and 10-year corporate bond has a yield 8%. We have two long-term bonds, treasury and government. As we said, treasury long-term has risk-free rate plus inflation and plus maturity. No liquidity and no default. Inflation will always be there. Doesn't matter if it is long-term, short-term, treasury or corporate. Inflation will always be there. We always include inflation premium because there is no way out from inflation. So we are adding MRP, maturity risk premium, because it is long-term. And it gives us 6% as in the question. As well as the government corporate bond has also the same amount. Ilgar, let me finish. For the corporate bond, long-term corporate bond, all of the risk premiums will be included there because it is corporate, liquidity will be there, default will be there, maturity will be there because it is long-term, and inflation will be there because there is no way out from inflation, and risk-free. So for the corporate, it is risk-free plus IP, inflation plus maturity plus liquidity and plus default, all of them. We already know this part, which is equal to 6%. So I replace this amount with 6% and adding liquidity premium and default premium, because this 6% represents risk-free rate, inflation rate, and maturity rate. So liquidity is also given as 0.5%. So solve equation for DRP, you will find default risk 1.5%. Is it clear now, Nuria? Ilgar, if question would ask 1 year government bond, we will not find average of PV in any case, right? Not because it is 1 year. Neyin average tapassan? Clear? Guys, thank you for your attending. I love all of you. Thank you for being here, taking your time. Good luck to you. Stay healthy. Keep your safety. And I will upload all the recordings, the Excel file, Excel questions we solved, and the solutions for Excel questions. And I hope my sessions are useful for you, beneficial for you. I am doing my best. And also, I am planning to join one of your classes, most probably at first class, 10 o'clock. I will be joining at 10 o'clock class. Yes, guys, see you next Monday. Let me stop recording.